And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show, where today we're going to be exploring the bridge collapse in Baltimore and going into deep engineering and technical design structures for that. I'm just joking. It's always funny when these things happen. Immediately everybody's an expert on whatever it is, right? So we're not going to talk about a bridge collapse today, but it is a terrible thing. The ship ran into a bridge. The bridge is now collapsed. 7 people are missing. So again, just a terrible way to start your day going to work. So anyway, a couple of things out today. We've got more economic data out today. Yesterday, the Dallas Fed Manufacturing Index came in much weaker than expected. And again, these regional manufacturing indexes continue to be fairly weak. And again, it doesn't really suggest that, at least from the manufacturing side of the economy, that things are really improving to any great degree. Services continue to be okay. And, you know, in our economy today, about 80% of the economy is services. So again, it really kind of dwarfs the manufacturing side, but nonetheless, the manufacturing data certainly suggests that the economy is not nearly as strong as, well, a lot of these headlines suggest. But again, that's neither here nor there, because the markets don't really seem to care about that as, you know, we kind of continue to ratchet it up higher. So, you know, those are the, you know, it's kind of the underpinning. And, you know, what's interesting at the same time that this is happening is that economists are ratcheting up expectations for GDP growth this year. We're now up to 2.1% for economic growth this year. That's up from 0.6 last year. So we've had a very, very sharp increase in the expectations for economic growth this year. And again, now the assumptions for a recession have fallen to zero. So nobody expects a recession. And of course, this is still with very high interest rates and inverted yield curves and everything else. So it appears, at least for now, that the Federal Reserve has done the impossible, which is navigate this soft landing. Now, a lot of people go back to 1995 and they go, well, you know, the Fed navigated a soft landing back in 1995. And technically that is sort of true, but there was never an inverted yield curve until 1998. Then we had a recession 2 years later. So again, you know, we're in an environment where we do have an inverted yield curve, which has always led a recession. Leading economic indicators are negative. You know, those manufacturing index is negative. A lot of these indicators, full-time employment, suggest that a recession risk is still viable, but yet now nobody expects one. So again, you know, we'll see what happens here, but again, markets are exceedingly bullish. And as the markets are more exceedingly, and this is something we'll go through today. We have some analysis on the website this morning talking about technical and valuation measures. But overall sentiment in the markets are very, very bullish. Expectations for continued earnings growth is very, very bullish. So it's interesting that at the same time that we have these underlying issues with weak economic data, et cetera, that the bullish side of the markets from all this liquidity that's just flowing into the market is continuing to boost these more bullish outlooks. In fact, if you take a look at retail investors' investments into futures, where they're now trading stock future contracts, et cetera, that is now the highest level on record ever. So retail investors are about as bullish as they can get. Institutional investors also extremely bullish. They have some of the largest futures positioning since the financial crisis. And again, so everybody is, you know, virtually in the boat. So as we talk about markets and positioning and those type of things, it's really difficult to find out how you're going to get people even more bullish than they are right now. But again, that's just kind of where we are at the moment and the things that are going on. But again, keep a watch on the data. The data is still important. It just hasn't mattered up to this point, and maybe it will at some point. But we're now 5 positive months in a row. And that's a very long stretch for the markets. In fact, this is what you need to know before the bell this morning. So over the last 5 months, the market has yanked out a positive rate of return. So this market's just been climbing steadily for five months. And again, this is not uncommon. It happens, but it's a very rare occasion that it happens in the past. And again, as we've talked about before, when markets are this deviated from the 200-day moving average, well, that's where it becomes a bit more problematic. Now, here's the problem with this chart. This is 2018, and this is what happened post-2018. When you had that record deviation from the markets came down and connected back to that 200-day moving average. So again, we've been in this situation before where we've had very big deviations and very big movements for the markets. Now, this is the interesting thing about this period of time is that we had a very big deviation from the 200-day moving average. The moving average corrected, tested to it. We then did it again, and just a few months later, going back into 2019, we get another very big deviation, and that deviation then corrected back below the 200-day moving average. Of course, this is 2020 now, this is late 2019. And, you know, when we have these big corrections like this happens repeatedly over time. So again, you know, it's easy to take a look at a market that's just trending higher and go, oh, this is great. We're now 5 months positive. And statistically speaking, once you're 5 months positive, that means the rest of the year is positive and we're going to have a big upside from here. And those are certainly what the statistics bear out. And it's very possible, it's highly possible, that the end of this year will be a positive return for the markets. Now, this is always the problem with a lot of this data when you see it. It'll say, okay, when you've had 5 positive months of the year, then the rest of the year is positive, and it's positive by this much, this percentage of the time. Okay, that's talking about full year returns. It doesn't tell you what happens between now and then. So again, yes, we're positive for 5 months in a row. There's very likely a probability we're going to get a correction. Again, we see this all throughout history. If we just take a long-term look at the markets repeatedly go up and down over time. And again, we retest this 200-day moving average on a repeated basis. You're going to have a reset at some point. It's just a question of when. Now, again, a retest of the 50-day moving average is about 10% from here. So it's not that far away. Sorry, the 200-day moving average, a retest of that is about 10%. So it's not a massive correction that we're talking about. It's no reason to go, hide in the bunker. But you are going to get some type of pullback. It's just a function of how markets work. It happened last year, in particular, as we were getting ready to go through, we were doing the AI chase into June and July, 5 months positive. Actually, we were 7 months positive at that point. And we said, look, we're going to get a correction. And ultimately, you got that. You're going to get the same thing here again, a retest of that 200-day moving average at some point. It's just a function of when. But for now, it's all risk on. There's absolutely nothing to be concerned about at the moment, because at the moment, everybody is bullish. So everybody's trying to get into the markets. They're chasing asset prices. The fear of a correction is non-existent at this point. Take a look at volatility index as an example. There's virtually no fear of a correction. So again, that kind of excitement, that momentum, that drive behind the market, that psychology is going to continue to push asset prices higher, at least for now. Now, at some point, you're going to get that correction, and again, it'll be a buying opportunity because, again, statistics bear out that when you have 5 months in a row, you typically are going to finish the year out on the positive note. So you don't want to be, out of the markets entirely, but look for that opportunity of that correction at some point, reduce some risk, look for that opportunity of a correction, add risk back to your portfolio. End of the year will likely be positive, particularly post-election, once we get to that part as well. So again, just something to think about as you get ready for the markets this morning, but that's what you need to know before the bell. We come back, we'll pick up on technical measures and valuations and what's that telling us. That's today's blog on the website at realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, and welcome back to the show this morning. So today's post on the website is talking a little bit about valuations and technical measures, and we're going to go through some of those charts this morning because, again, this is just kind of where we are within the markets. And again, we're just, none of this is unusual. It's not unexpected. And I guess that's not really the case, because I guess we could say, well, it's unexpected because it's unexpected that we have this much exuberance in the market at a time where the Fed's still hiking rates, right? Or have hiked rates. And we have a very high level of interest rates and markets are exceedingly exuberant. And so, when we take a look back at history, one thing that we notice is that when the Fed starts cutting rates, generally that's when the markets tend to not perform well. And the difference this time, and I hate saying that, but this is the thought process anyway, is that everybody's anticipating the Fed to cut rates because that provides more liquidity to the markets, and providing we don't have a recession, which is the overall riding expectation right now, that extra liquidity will just cause asset prices to go higher. So there's no downside risk. That's the premise of the markets right now. And because of that, everybody is getting into the markets. And as I said a minute ago, everybody's exceedingly bullish. In fact, if you take a look at the Bank of America's Global Risk Appetite Indicator, it's now at one of the higher levels, historically. And so, that's kind of the interesting thing of what's happening. Is just everybody is very, very bullish about the markets overall. And it also makes me realize how old I am when you can go back a decade and not even get to the financial crisis now. So, time flies. We were doing this show all during the financial crisis and going through all that. And now you have to go back. You say, well, 10 years ago, you're not even back to the financial crisis anymore, right? You're back to 2014. So we can't say in the last decade there was the Brexit issue, right? That was 2015, 2016. So we haven't quite wiped that out of the last decade of market returns just yet. But, when you talk about valuations, and, this is important, it is often, a lot of people say, well, with market valuations where they are right now, I don't want to be invested in the markets. Because, it's just, whenever you have high valuations, you have low market returns. And that's a true statement. But the problem is that valuations are a terrible market timing device. Valuations can remain elevated for much longer than you can imagine. And they have over the last 20 years. And what valuations are simply a measure of psychology. Because it's when investors begin to pay more for earnings than what the earnings actually are. So they're betting on future earnings growth being higher than even current estimates are. And so I'm willing to pay up for that. I'm willing to pay up for NVIDIA at 35 times price to sales because they're going to grow earnings at 400% a quarter every quarter from now on. That's just not the case, but that's the general premise. And so if we take a look at valuations versus consumer sentiment, we see a very high correlation. And that should not be surprising when consumers are exuberant and things are rolling along and everybody's happy. People are willing to pay more for stocks, and vice versa. When sentiment is very poor, that's because the economy's poor, something's going on, something's happening, and they're not willing to pay that much for valuations. But we can take a look at the history of valuations, obviously, and when you've ever paid too much for valuations, returns have been poor. And there's a very high correlation between the ebbs and the flows of the financial markets versus valuations. And so, we're currently trading at 34 times earnings, and that's a very rich valuation. It's pushing levels that have previously led to poor outcomes for stocks. But again, doesn't mean today. Doesn't mean next week, doesn't mean next month. Valuations are a longer term indicator. And it's simply a measure of exuberance. And what valuations tell us is that investors are very exuberant right now. And there's issues for that ultimately, but at least at the moment, that's what it's telling us. And again, we can see that exuberance through household equity allocations. investors are piling into equity allocations on the household level, and they're just saying, I just give me all the equity I can get. In fact, we're at the second highest level on record right now in terms of household equity allocations. Now, look, that's a positive too, which is that we've got more and more households investing into equities. They're making money. That's helping their financial situation. So we don't want to discount that at all. But there's also the psychological side of this, which is that, everybody's in the boat. And if everybody's in the boat or in the pool or whatever the metaphor is that you want to use, typically that is the point where markets are about as exuberant and overvalued as you can get them. Now, remember, think about it this way. Sam Stovall from S&P once said that if everybody's bought, who's left to buy? Right? So remember, the markets are simply a function of buyers and sellers. And on one side, you've got the buyers. On one side, you've got the sellers. Well, right now, nobody's really willing to sell and everybody's willing to buy. So prices are going up because in order to get somebody to sell, you've got to raise the price to get them to sell, right? I've got to bid up for it, and that's how I get somebody to sell something to me. And so again, sellers are present, but only at higher prices. And so that drives the market higher. There's a liquidity issue, right? There's not that many people willing to sell versus the numerous people wanting to buy. And so prices go up. That's supply and demand. That's how a market works. Now, at some point, something's going to happen. Whatever it is, it'll happen. Some event, some outcome, something changes, psychology. And at that point, all the buyers out there will become sellers. And the problem is that all the people that were selling, they don't want to buy at these levels. You had to bid them up in order to get them to sell to you. And so they don't want to buy at this level. Sellers are going to be down somewhere else. There's an old saying that buyers live higher, sellers live lower. So this is going to be the problem ultimately, is that in order to get somebody else to buy from you at this level, you're going to have to drop your price a lot, and that's going to drive prices much lower before you can get that. And then as prices drop, as sellers will become more available as prices drop. Because now all the people that were buyers are now sellers, and there's going to be a rush to get out. And so those buyers are going to be down there somewhere at a much lower price. So thinking about this, we can kind of look at some technical measures, we can look at some other things, and we can kind of make some assumptions about where we are in the current cycle. And this is the thing that we wrestle with, and this really isn't new information, right? We all know this. This is pretty self-evident about what's going on, but the question is how much longer can this last, right? How much longer is this market going to continue to rise until you get at that eventual correction? And so there's certain things that we can look at that we can say, okay, well, look, historically, this has happened. And historically, when this has happened, you typically get some sort of correctional process along the way. And so one of those things we can look at is taking, and again, this is one of my favorite ways to look at markets because it has such a high correlation to eventual outcomes, and that is technical deviations of the markets from their long-term moving averages. And so if we go back and look at a technical model, so this is just simply a model that looks at technical deviations from the 2-year moving average. So this is a very slow turning moving average. So 2 years in the making. And when you get deviations this far away from that 2-year running moving average, you've typically formed or been in the process of forming a market peak. The last time we were here was at the peak of the market last year. And then we had that 10% correction. Go back to, 2019, 2020. Same type of thing. So we've seen these correctional processes over time.
And they all start from these very big deviations throughout history. This goes back to 1900. These big deviations lead to at least corrective events. It doesn't necessarily mean that you're going to have a massive bear market. I'm not saying that at all. But you can have pretty significant corrections, 10, 15, 20%, when you're this deviated from those longer term moving averages. So we can use this as a technical model and say, okay, what is the expectation of market outcomes based on current technical deviations? And there's a very good correlation between those deviations and the outcomes of the market. Now, timing is always the problem, right? And so this is the problem right now is like, well, Lance, if you say the technical deviation is this, I'm just going to get out of the market. I'm going to wait for the correction. Well, the problem is it could be another 2 years. The timing is always the issue. See, recognizing the problem is important. Defining the time frame is much more difficult. And so we'll come back and we're going to overlay a little bit of the technical and the valuation model together and look at some really long-term kind of analysis to understand exactly where we are. So don't go away. More of the Real Investment Show coming right up.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back. Talking a little bit about market valuations and deviations, technical measures, etc., and just trying to get a determination of exactly where we are within this current market cycle. And again, as you know, this is the big conundrum. It's just everything is bullish right now. There's absolutely no reason to worry. At least it seems that way, right? It's just markets go up every day and just buy and hold. It's fine. And there are certainly times in the market that is the case, and this is one of those. In fact, I haven't seen one of these periods like this really since 2018 and really 2019, going into 2020, where it's just this very complacent, hands-off, don't worry about the markets. We saw it in 2021 when we had those $5 trillion of stimulus checks coming into the markets. This market was a very low volatility advance just for an entire year. It just kind of grounded higher. And that's kind of where we are now. There's just simply no concern about the markets. And it's interesting. And so if we take a look at, again, going back to 1900, taking a look at long-term valuations and measures. Now, this chart is quarterly data, so it's very slow to turn. But again, we look at these measures, there's very few periods in history where you have the market trading at 3 standard deviations from quarterly means. RSI is above 70. The relative strength index is above 70 on a quarterly basis. The deviations from the long-term means, the 3-year moving average in this case, is very deviated. And so when and valuations are high. So it's very rare that you have all of these ingredients kind of all together. And whenever you've had them like this, you eventually get a fairly significant work off of that. Last time we were here was at the peak of the market in 2022, and then we had that 20% correction in 2022, and that kind of worked some of this stuff off. And now we're back. So, this is just kind of the environment that we're in. So fundamentally and technically, markets are very extended. And again, there's nothing wrong with that. These are just measures of exuberance, right? So this is just the measure of exuberance itself and the manifestation of that exuberance. And so we can apply all this together and build a technical and fundamental model. And if we look at the technical and fundamental model, the dark gray areas are when both the technicals and the fundamentals line up. And again, the last time that both the technicals and the fundamentals completely lined up across the board was in the peak of the market in 2022, January, February, March of 2022. And then that preceded that 20% correction we had. Now, we're just shy of, and in fact, if the market stays where it is through this month, because again, this is quarterly data. So if we get through the end of March, the end of the first quarter, we are where we are, it'll likely trigger another signal because everything is there. We just got to finish the quarter. But historically, whenever you've had all these alignments, as you have now, you've had some type of corrective action. In fact, you can just look at the chart and the gray bars and it kind of tells you what you need to know. And this goes back to 1900 again. So again, when we take a look at this, there certainly should be some caution into how much risk you're taking within your portfolio. But again, it doesn't seem to matter at the moment because at the moment, everything is fine. And again, this is the important thing, and this is the conclusion that we come to in the article, which is the problem with long-term, I'll just read to you. The problem with long-term technical measures and valuations is that they move very slowly. Therefore, the general assumption is that if high valuations do not lead to an immediate market correction, the measure is flawed. And that's where we are today. Valuations don't matter. These technical measures don't matter because this time is different because of A, B, or C. Pick your poison, whatever your reasoning is. And again, as we said before, in the short term, valuations have very little to do with what's going on. It has very little relevance to what positions you should buy or sell, anything else. Because again, valuations are more of a measure of psychology than anything else. And holding periods today have shrunk to just 4 months. And so even most investors are working in such a shorter time frame that valuations don't matter as much as they used to. But it doesn't mean you should ignore them entirely, because they do matter. And, you know, in the article, I go through a kind of a important example. I said, think about it this way. If you take a bunch of ingredients, if I give you a pile of ingredients, right? I give you some nitrogen, some glycerol, some sand, some shell. I just put them in piles on the ground, right? Most of you probably look at me and just go, okay, great. What do I do with that? Well, the problem is that in and of themselves, they don't matter much. Now, if I properly combine them and provide a binder, I get dynamite. But dynamite itself is completely okay as long as I store it properly. Dynamite's only dangerous once you apply some type of catalyst, like a spark. So the markets are very much like that. If you take a look at the ingredients of the market: leverage, valuation, psychology, ownership, momentum. In and of themselves, any one of those are innocuous. Combine them all together, there's certainly the risk that they provide a mean reverting event, but the thing that it lacks is a catalyst. So right now we have leverage, valuation, psychology, ownership, momentum. All the ingredients are there for a mean reverting event. The only thing that we're missing right now is a catalyst. What is that catalyst going to be? I have no idea. Neither do you. All these guys on the internet or on, the media, et cetera, saying, oh, we're about to have the world-ending event. It's going to be because of this reason. That's not the reason. If they're thinking about it, the market already knows about it. You'd be better off saying the market's going to have this big mean reverting event because we're going to get attacked by aliens, because that's something that the market is not pricing in. But it's got to be some event like that exogenous, unexpected event that all of a sudden turns all those buyers that are all crowded into one room trying to buy stock right now into sellers. And then once you get the selling to begin in mass, buyers will live a lot lower. And that's how you get that correction. But again, we just don't know what that is. It's just something that's hard to fathom. And again, this is what causes liquidation events. This is what causes liquidation cycles in the market, is that unexpected exogenous event that comes along and triggers that rush for the exits. Right now, everybody believes bear markets are a relic of the past because the Federal Reserve and quantitative easing and all this. And I'm not sure that's the case. Maybe. We have certainly figured out through financial engineering that we can mitigate the risk of recessions. We can mitigate economic downturns. We can stall market downturns through monetary policy and fiscal interventions. We now know that. We did that in 2020 with $5 trillion worth of stimulus. And I am sure that in the event of another major downturn in the markets, that the government will very quickly go back to sending checks to households because it worked last time. It'll be full speed ahead, damn the inflation. We're going to send checks anyway. And it'll be, we'll send checks this time because we understand that it'll cause inflation and we'll be prepared for it this time, and you won't be. But, this is going to be the point. But over the last 14 years, the Federal Reserve and the government have figured out how to forestall recessions and how to delay negative economic impacts through monetary and fiscal interventions. And we're going to continue to do that now. That's the new playbook. Now, the question at some point is that at some point we're going to show up and do something and it's not going to work for whatever reason, because that's the dynamics of how markets work. Eventually, markets will say, okay, I expect this, but this is different. We'll see what happens when. But for right now, again, there's nothing to be concerned about. Today, don't walk away from the show today and go, I need to sell because Lance is saying that this is all going to be bad outcomes. We're going to have a reverting event at some point. It could be tomorrow. It could be 6 months from now. It could be next year. It could be 2 years from now. That's the problem with the data. The timing is nearly impossible. For now, you just got to kind of ride the market, participate in it, enjoy it, benefit from it, and just be aware that these are the risks that exist and be willing and able to make a change when that time comes. But that's not today. All right, we'll come back to the break. I want to talk a little bit about Larry Fink. He's out with a new warning message this morning, which is kind of interesting because it kind of dovetails with the article I wrote on Friday. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So on Friday, I wrote a little bit about the Social Security retirement crisis. And it's not just Social Security and Medicare, which is $174 trillion unfunded liability, but it's also pension funds, which run the risk of a retirement issue. And we've had a big ramp up in the number of retirees over the last couple of years because of soaring stock markets. People are feeling better and they go, well, I'll just retire now. I'm going to get out of the rat race. And so we've had a abnormally high level of retirement over the course of the last couple of years. Now, the reason that's important is because all these pension funds, Social Security, Medicare is based upon actuarial tables saying, okay, we expect this number of people to retire, and based on these assets generating this rate of return, I can fund these retirees at this certain level over this period of time. And then they're all supposed to die at a certain period of time as well. That's all the actuarial tables tell you. Do you have enough money or not based on these projections? And so if those projections change, if you have a higher retirement rate, people live longer, whatever it is, that can really mess up the outcome of those plans. And all of a sudden you find yourself grossly underfunded. Larry Fink came out yesterday and was saying the same thing. And I thought it was interesting because I just wrote about this on Friday. That article is on the website right now at realinvestmentadvice.com. The 71-year-old chief executive of BlackRock says an aging population is stressing retirement safety nets such as Social Security, an issue that is set to worsen as medical breakthroughs like weight loss drugs extend people's lives. Again, so there you go. People living too long, retiring too soon, threatens those retirement plans. Now, for BlackRock, about half, they manage $10 trillion. About half of that is retirements, pensions, those type of things, right? So it's a threat to their business as well. Because yes, they're managing those assets, but if the withdrawal rates of those assets exceed their return rates, well, they start losing assets over time. So, in fact, here's from the Wall Street Journal. BlackRock, the world's largest asset money manager with $10 trillion in assets, says more than half the assets it manages are for retirement. So how do you forestall that? Well, we need to get more people, this is according to BlackRock, getting more people investing more of their assets in capital markets is key to securing a comfortable retirement for him. Right? Got to keep him in business. So we need you to invest more so they can continue to charge you fees, and that continues to pay Larry Fink's salary. No other force can lift more people from poverty or improve the quality of life quite like capitalism. I have an article coming out on this on Friday. The problem is the wealth gap. It sounds great that we should get more people invested into the financial markets, but just recently, Fidelity came out with their 401k millionaires. How many people have 401ks with $1 million in them? And not surprisingly, that number rose over the last year as the markets went up. And they're now almost at a record number of 401k millionaires. And they say, hey, we had 224,000 401k millionaires. It's a lot. 244,000 people around this country have a retirement account with more than $1 million in it. If that's you, congratulations. What they don't tell you is that you have to divide that by all the retirement accounts that they manage, and you find out that's 1.6%. So roughly the top 2% of the population. How about for everybody else? The average balance is around $100,000. The problem for the vast majority of Americans is that, yes, we should, try to get people to invest more into the financial markets. That's great for Wall Street because they're the ones selling you the product. And as long as markets are going up, everything is fine. What they forget to tell you is that when you have a mean reverting event, it tends to destroy people's retirement accounts. And generally that occurs right at the time they can't afford to take the loss. But Fink offered his thoughts on improving retirement systems, addressing the national debt, and investing in the global energy transition markets, which is interesting because there was another article out this morning talking about the decline of the EV market, and that we're starting to see less viability of the electric vehicle market because of its various issues that it has. Nissan aiming to cut costs by 30% simply to remain competitive as the EV market declines. And that's because EVs aren't nearly as cost efficient as they were originally thought that they were going to be. So this whole global energy transition thing is very important because people are coming to realize the importance of oil and gas and energy infrastructure, because that's where electricity comes up. And it's great to have all this electric vehicle stuff as long as you have the stuff to make the stuff that makes electricity. So he's talking about that two of the biggest economic challenges in the mid-21st century will be providing secure retirements and building the massive amount of infrastructure the world needs. Well, we've been talking about building massive infrastructure for decades. We were talking about doing infrastructure building back in 2008. That we had a very old and inadequate electrical grid in the economy that needed to be updated, upgraded, and we passed an $800 billion bill to do that, and we never got it done. We talk about this stuff all the time, right? We just don't do it because we always need money for something else. But he's got a point. The problem, though, is that, yes, we need to get more people invested for their retirement. And again, you're listening to a boring talk show about money at 6:54 in the morning because you have money invested. So that's great. 50% of the population has no investments at all. The next 30%, the 50 to 80%, have very little invested. And they're simply struggling to make ends meet. So there's not a lot of excess money to put into the markets. And it's always interesting because I see on, various social media posts and this type of thing that, it's like, well, if you just invest $1,000 a month into the markets, by the time you get to retirement, you'll have this much money, millions of dollars in retirement. The math is correct to some degree. It uses kind of set rates of return, which isn't realistic. But overall, the growth of money over time is important. In fact, if, most of us, a big chunk of us in the economy today have lived to see one, if not two, of the largest bull markets in history, 1980 to 2000, 2013 to now. Or 2009 to now, I should say. If I just had invested $100 a month in 1980 and just kept doing that till now, I'd have $1.4 million in the bank. So, it's just, it doesn't take a lot to invest capital to get there. The problem is the lack of capital to invest for most people. Most people are just struggling to make ends meet. And they're having to go into debt every month. And this is some of the analysis that we go into on Friday. But looking at debt to income ratios for the bottom 80%, et cetera, there is no excess capital. They can't afford to invest in retirement accounts or investment accounts or anything else. So all this stuff sounds great. We just need to get more people to invest. Well, the problem is that we're not growing wages at a scale that allows people the ability to live their life and have money to invest. See, this was the big benefit of pensions before we got rid of them. Back in the day when you had pension plans, the company contributed to that pension plan for you. So you went to the job every day and you did your work. And for 30 years, you worked for that company and your pension was building. And when you retired, you had that pension plan. But that was a burden on the company because they had to fund those. And so when 401ks came along, corporations said, oh, this is great. We can get rid of that burden, put more money on our bottom line, put more money in the pockets of our executives, And we'll just put the 401k burden on the employee. So now he has to save for his own retirement. And that's been an unmitigated disaster. Nobody wants to admit that, but it has. Out of all the 401, so out of the entire population, we've gone through these numbers before, but out of the entire population, only about 50% of employees actually have access to a 401k plan. Most small businesses, which are about 50% of the employment in this country, don't do 401k plans. They're too costly, too expensive, and to administer for a company with 5 or 10 employees. Out of the 50% of the employees that actually have access to a 401k plan, only about 50% of those actually contribute to one. So if you take a look at total population, only about 25% of the population actually contribute to 401k plans. This is why you have a retirement crisis. So for BlackRock, they've got a problem coming down the road. People are retiring too fast, too soon, and living too long. It's going to be a problem for their asset drain in the future, which, when it comes to Larry, couldn't happen to a nicer guy. All right, wraps up the show for the day. Be back tomorrow with Danny Ratliff. Oh, sorry, John Penn joining me tomorrow. Danny Ratliff is out, so John Penn will be here tomorrow. We'll pick up on the markets, your money, and what to talk about then. Be sure and like and subscribe to the channel. We certainly appreciate it, and we'll see you back here tomorrow.